People always say that you have to have money to make money, and that there's an extraordinary level of sacrifice on the road to success. So how is it that investors like us who didn't start out with much money and who don't rely on banks and credit, how is it that we can increase our income and build our wealth in a way that doesn't require us replacing one full-time job with another while still enjoying the things in life that matter most to us? That has always been the big question, and this podcast reveals the answers. I am Carrie Like, and this is the Investor Warrior. Hey guys, and welcome back to the Investor Warrior. I hope you're all having a fantastic week, and TGIF, it's Friday. Thank goodness. So on today's episode, I have a good friend of ours, John Bell, and I wanted to bring John onto the episode today because he is, what did you call it? What do you call yourself? A financial planner entrepreneur?
Financial services entrepreneur.
Financial services entrepreneur. What does that mean? So introduce yourself and tell us what that means.
Well, first and foremost, I'm an entrepreneur, right? So the definition of an entrepreneur is the French word that says an undertaker, someone who undertakes the task of improving things. So that's how I see myself primarily. And then the offering that I make to my clients is financial services in its orientation. I have a mortgage company, so naturally we can assist in purchasing of real estate, refinancing of real estate. But at the same time, I also have a financial planning business, which I can help people plan for the future, get their estate planning in order, take care of all the things that are necessary for businesses, business succession planning. So there's a broad scope of things that I can do. So that's why I describe myself as a financial services entrepreneur. It's just the most concise way that I believe I could tell people quickly what I do.
Right. And so you are both financial planner and a mortgage broker. So how long have you been doing this?
Yeah, I'm 56. I got in the mortgage business when I was 22. Wow. And rode that wave from being an independent mortgage broker with a one-man show to selling that business, merging with a partner, selling my half interest to that partner, and then creating my own business with my wife in 1994, all through the 2008 unwinding of the credit markets. And then in 2006, I was focused on a concept called the two business solution system, which is where you have your present business and you have your future business. And you have to keep focused on the fact that you always have two businesses, the present business and the future business. And I decided that I wanted my future business to look like one that could offer additional services and products as well as the mortgages. So as I was beginning to build that future business, the 2008, 2007 unwinding occurred, and I segued from the present business to the future business faster than I anticipated, because it was very difficult to originate mortgages and actually make a profit for a good solid 2 years.
Right.
In some cases, as much as 3. So that's a long time. So
that's interesting because I think a lot of mortgage brokers didn't survive that time.
No, they did not.
Mm-hmm.
It was an extremely difficult time. We had, I think we had something in the neighborhood of 5 or 6 different locations. We were a mortgage bank. So we had in-house underwriting. We had warehouse lines. Our main warehouse line lender at that time was Countrywide. They were the largest wholesaler in the country. They failed. They were acquired by Bank of America, and then Bank of America acquired Merrill Lynch as part of a broker deal between the Fed and those two counterparties. So we survived in that we had a new business model. So we just simply changed our overall approach and became financial planners sooner than we had anticipated. And then we came back around.
That would have been also a crazy time to get into financial planning, because during that time, a lot of people lost an incredible amount of net worth.
They did. Yeah. That's true. It was less difficult to be in financial planning as it was in mortgage lending, because many people still had money, or they had a desire to get their money back, and they wanted someone to be able to be there and coach them and help them. And so we essentially spent a lot of time focusing on our financial planning business. And then I read something in the neighborhood of 50 books that year on economics and finance and history to try to get a sense of context so I could get a feel for where we were going to go.
You read 50 books.
Oh, it might be a slight exaggeration, but it was a lot of books. I mean, I don't think that was that far off. It was a lot.
So what are some of the things that you learned during that period of time, reading the books, coaching people through this incredibly difficult time?
Mm-hmm.
And you were basically starting a new branch of your business at that time.
Mm-hmm. Mm-hmm.
What are some of the things that you learned during that time?
Yeah, well, my goodness, I got a much better understanding about how the Federal Reserve um, was kind of the de facto source for so many businesses.
Mm-hmm.
And being in mortgage banking, I was essentially very dependent on the credit markets operating and functioning. And to this day, Fannie Mae and Freddie Mac are still in receivership. So it's 14 years later. And once something happens with the federal government taking control of something, they very rarely relinquish control because it's how they operate. So I learned a lot about the Federal Reserve System, monetary system, the credit markets, of course, the mortgage-backed securities market, leverage. So that was probably the biggest takeaway. And then, of course, the next one was how to really make sure that you stay connected to your clients, and your clients really want, in my opinion, to have threats removed, and they may not consciously be thinking about any threats because things might be going very well for them. Well, during that time, more people than not would not be saying things were going better.
Mm-hmm.
So helping people identify threats and then mitigate against those threats in a planning model became really the primary focus of how I dialogue with clients.
Mm-hmm.
What threats do we have that are in the future that you see that we want to eliminate or mitigate against any risk? And then what's your vision about where you want to be?
Mm-hmm.
So I try to always start out with, if we were sitting here 3 years from today, looking back on the 3 years, what would you like to see have happened to be happy with your progress?
Okay.
And to some people who don't have a future vision of themselves, that's probably a question that might frustrate some, but by and large, most people respond positively. And almost exclusively, my entrepreneurial clients will go and tell me everything.
Okay. Yeah. What are some of the biggest threats that you see people being concerned about when you're coaching them?
So if it's an individual that's not a business owner, it
Mm-hmm.
may be not having enough money when they reach a phase in their life where they are going to retire. And there are people that are heavily focused on retirement. They're what, I guess Kiyosaki would say in the rat race, right? The Rich Dad Poor Dad. And I read all of his books, by the way, in 08, 09. So they're in the rat race. And so they may need somebody to help them get out of the rat race in their mind, and then also focus on how we can accumulate enough money so that when they reach a phase in life where they are either taken out of the office on a stretcher,
Mm-hmm.
or taken out of the office involuntarily or leave voluntarily, however they choose to leave their career.
Yeah.
We want to make sure that they can see a plan on how they'll have cash flow that will give them a standard of living that they want to maintain.
Yeah. And you're working, I assume, with a lot of real estate entrepreneurs.
Mm-hmm.
Yeah.
So entrepreneurs are different because we are entrepreneurs, right? So we operate in a different time system.
Yeah.
You have an entrepreneurial time system, and then you have the other time and effort time system. So I tease my wife because she does consulting and project management, and she charges a nice hourly rate, but she's on the clock. And so I tease her a little bit, but that's how her brain works, and that's fine. And it works well for her, but she's in the time and effort economy. Entrepreneurs don't necessarily have to look at retirement the same way that many others have to look at it, which is not to say that entrepreneurs are better, because a lot of entrepreneurs end up with nothing. They can go up, down. I've seen people that were worth $100 million that are now flat broke.
It's the uncertainty of being in entrepreneurship. You're in a world all the time. Mm-hmm.
So that time system's different. So talking about retirement to a successful entrepreneur is not something that they're that enamored with, but they do want to see the legacy component, and they want to see what it would look like when they're 70 or 80, and they may have a block of 100 homes or an apartment complex or a mixture of paper assets and hard assets that it's generating income. And that's more of the estate planning. And that's my area, which I know that you know, is that I really enjoy helping my clients do estate planning. That's my sweet spot. I love helping them
Mm-hmm.
understand which trust structures would be appropriate, if any, how they want to leave their life's work, to whom they want to leave it, and under what terms. Um, and so, yeah, so it's a different conversation with entrepreneurs. And they also, depending upon the size of the teams they may have, there are your more typical rugged individualist entrepreneurs, which is an area that I'm familiar with. And then you may have ones that really respect and appreciate having a unique ability team. So
Mm-hmm.
and I love doing consulting with them outside the scope of the financial services, where we do a Colby on everybody, which is the Colby.com site that measures how you get things done. And I just love helping people figure out the appropriate place that their team members are going to be highly suited to serve the growth initiatives of the company.
Yeah. I want to go back to the 2007, 2008 era. Did you see the crash coming, being in the mortgage industry, seeing all these crazy loans?
No, no,
No.
I'll be honest. When you're so in your business, right, and even working on the business, you may take a macro look of you have to have your time blocks so that you're not just falling prey to being a rugged individualist and being in your business nonstop. So I had an appreciation and the ability, because of the team that I had, to step back and work on the business, but
Mm-hmm.
I didn't see the tea leaves uh, as well as I could have. I remember it was November 2006, and we had essentially printed money. We were just
Mm-hmm.
really doing very well, and everybody in my industry was doing well.
Sure.
And I looked at some numbers from my internal accountant, and looked at our gross receipts, looked at our expenses, and we didn't do as well as I thought we should have for the month of November and December of 2006. And I couldn't get any sleep, and it was worried and worried and worried. So that would be the closest I think I could say that I got to it, where I started to examine some of those numbers. Right now, what's happening is the 2-year, the 10-year are becoming inverted. So you're finding that a lot of lenders are going to become less friendly with locking in rates. They're not going to be making those big profits of what they call positive arbitrage on their lines, because you're not lending your own money, you're lending borrowed money at a lower rate. And when we had the COVID kick in, a lot of those non-qual lenders were out of business for 3 or 4 months. They couldn't even operate, because they didn't have the ability to access the credit markets in an inexpensive way to circulate that paper. So I saw some of the things, but I was fortunate in many ways because I had the two business solution. I had been focused on the future business. So if you're always focused on that future business and you're focused on projects when you're working on your business, on what the next iteration looks like, it gives you a reserve tank to be able to not crash into the ocean. You actually, I have a reserve tank. You can flip that button and continue to fly. You might not be flying at 30,000 feet. It might be 10 or 15, but you're still flying and you're still in the game.
Mm-hmm.
And that's the importance of having reserves, not ever allowing yourself to, and it's easier said than done, but not ever allowing yourself to see your liquidity versus your leverage ratios get out of whack. Because if your cash flow goes out of whack and you have some reserves in relation to your leverage, then you have those metrics, and you've been following that algorithmic discipline, so that, and when there's a bad time, because these setbacks are inevitable. Mortgage
Yeah.
originators right now are not very happy because volume's down 50% and they can't get their contracts accepted. So the originators who are exclusively originating will have to work 3 to 4 times harder, which there are many that will, and they'll do okay. But by and large, people get confused and they don't even know how to deal with these things because they don't even understand the context of what's going on.
Yeah. So I want to kind of unpack what is going on, because you said a lot in there,
Mhm.
in the last 2 to 3 minutes that I
Mhm.
want to kind of do a deep dive into.
Mhm.
But before we do, my other question going back to 2008 is, after you had started educating yourself, read the 50 books, started
Mhm.
looking into um, basically the whole system behind how all this works, do you think you would have seen what was coming? Do you
Oh
think
yeah,
you had
of
better
course.
context and perspective?
Yeah, so the Fed's balance sheet is a very important thing. The larger the Fed's balance sheet, the smaller the individual is. So you see these wealth gaps that are discussed all the time right now, right? And so the Fed's balance sheet right now, they're shrinking it, and they've even told the community how much they want to reduce it by. I think it's anywhere between 70 billion to 90 billion a month. It's at 8 trillion. But prior to the 2008 debacle, the Fed's balance sheet was 800 billion. It's now 8 trillion.
Wow.
So the printing of the money and the inflation that's now concatenated with that is confusing. And if you're a retiree living on fixed income,
Yeah.
your standard of living is going down right now. You're
Right.
not flying as much. You're going to be more cautious about how you drive. The federal, I mean, the Social Security increased 5.8%, but Medicare has been increasing at 7 to 8%
Yeah.
year in and year out. So yes, if I had the knowledge I have now, then naturally I would have been able to see it coming. Yes, of course. But so would everybody else that likes to read and
Sure.
do research.
Yeah. So let's talk about what's happening now, because the interest rates, let's see, about a year ago, I'd say maybe July of last year, we were at like what, 2.9%.
Yeah,
And
2.7, 2.9,
yeah. And as of today, what, 4 point,
7.5.
I was going to say 4.9 to 5 is what I was
Mm-hmm.
looking at.
Mm-hmm. And the
So,
conforming loan size.
so let's talk about that, because there were
Sure.
some big changes that happened just recently of these last few days. And you talked about this inverted relationship between the 2 and the 10-year. And how does
Mhm.
that affect what's happening in the mortgage world today?
Well, so firstly, there's two subjects. So the subject matter of higher rates. So the higher rates. So if you want to track, if you want to go to a search engine and put in something and then receive notices, you want to be tracking the 10-year Treasury, right? So the 10-year Treasury, I think, is somewhere around 2.7, 2.8 today.
Mm-hmm.
And the spread difference between the 10-year Treasury and 30-year fixed rates on average is about 200 basis points, about 2 percentage points. That's a very general, simplistic way to describe it. So the rates rising means that less people will be able to qualify because
Right.
and I always simplify it, for every 1 percentage point, it's essentially $1,000 per year per 100,000, right? So when you say $1,000 a year, that's the payment went up for every 100,000.
Yeah.
So if it's gone up 2 percentage points, your mortgage payment per year per 100,000 has gone up $2,000
Okay.
compared to what you would. So that's going to have a qualification impact, right?
Yes.
You're going to have, but what you'll find is that the government frequently, in their compassion, um, expands the ability to qualify so that they can be more socially nice or whatever it may be, help people out. So they'll have a tendency to stretch the qualification. So when the mortgage market begins to shrink, you'll see an easing. Hey, well, you know what? We'll let you use a smaller percentage of student loan debt to qualify. We'll let you have a higher ratio if this is where you are. And
Mm-hmm.
that's the opposite that should really be done, in my professional opinion, my humble opinion. You don't want to be encouraging large amounts of debt with somebody who's trying to get things done in their life, because you could be giving them problems. So that's part of where we're headed. But essentially, you're going to see there'll be an easing of some of the credit requirements because of the volume, and then you'll see less people qualify naturally, and so that's going to slow the ability for people in that affordable space to buy.
Mm-hmm.
And what you're seeing now is, if you look at the wealth gaps between, let's say, the 10 highest income states in the country versus maybe some of the lower income states, Florida probably ranks somewhere around, I don't know, 30th. I'm just guessing, but I'm probably not that far off. And Connecticut and New Jersey and
Mm-hmm.
New York are like number one, right? In California. So they're selling these large homes in these very affluent states, and they're getting a lot more for them than they asked because the market is
Right.
bidding them up. They're bringing that money to Florida, and they're buying homes in Central Florida through all these various counties, and that makes the houses less affordable.
Right.
And so you'll see less of the what I would call solid middle class, right? They won't be able to qualify. I'm sending people on their way to go buy a house, that have good incomes, but they can't get their offers accepted right now because
Right.
this new cash money, right, that's
They're
coming in.
competing against cash offers all the time.
And that money, in my opinion, is coming from other areas because now remote work, which was once a somewhat interesting concept, has become some more mainstream with many companies. They're allowing people to work remotely. So if you're living in Connecticut and you're making $700,000 a year, you're probably slightly upper middle class, not to be snooty. You come down to Central Florida, you're going to be killing it, right?
Yeah.
And you have your money and you can work remotely.
Yeah.
So I've noticed that country club membership dues have gone up, initiation fees have doubled, their waiting lists on all these places. All the private schools are doing well because all this money now is coming in.
I want to go back to what you said. So the qualifications for these loans are going to start to ease up, meaning it's going to be somewhat easier to get the loans. Wasn't that the same thing that was happening back in 2006 and 2007? Doesn't
You're
it?
exactly.
Do you feel like you're seeing some of these?
Okay. So here's the
What happened in 2007 to 2008 to what you're seeing right now? Because I think there's a lot of similarities, but there's a lot of differences as well.
So Dodd-Frank, right? The Dodd-Frank, Barney Frank and Chris Dodd, who were Congress and Senate, did this thing, and they basically changed how mortgages are originated. And they also changed how these taxpayer subsidized mortgages, because that's really what they are. Fannie and Freddie are subsidized by the U.S. Treasury ostensibly. The taxpayers subsidize all those loans. That's why you get a low rate when you get them compared to maybe one that's not. So they said you can't get a mortgage anymore that's going to be a qualifying mortgage without verifying your income. So the lot of me loans, the stated income loans, which were a fallacy created by credit scoring and modeling and loan to value assumptions, that was really the catalyst for the bubble. It wasn't the alt A's or the subprime. You'll hear people talking poorly about them. Yeah, they're higher rate loans, but it was the guy or gal who had a 770 credit score with 20% down for a second home. And by the way, they got the 20% down from a home equity line that was run quickly and approved. And so those created distortions. Now we had similar distortions that took place with PPP and these SBA loans. So you have $3.7 trillion worth of what's called fiduciary money sprinkled into the economy over COVID. So that's a distortion. So a lot of business owners that have seven figures on their balance sheet, they otherwise would not have it, that qualified for the PPP, used it appropriately, but it's on their balance sheet. So there's some distortions too. But I think we are seeing some similarities in that you're going to see them loosen up on some other things like appraisal waivers, debt ratios, student loan repayment obligations. So you'll see it's overly managerial tinkering with the economy, and they just can't help themselves.
That's interesting, even after everything that happened in 2007, 2008.
Yep, it is. And so there are some similarities that are happening right now, but they're not as extreme and they're not as pronounced because you can't get a mortgage anymore unless you have income. Now, you could have an investment property, and investment properties those loans are very nice to do if you're a mortgage broker, because if the rent that the person's receiving can pay the payment and they have a down payment with a good credit score, they can buy a rental property.
Without tax return.
No tax returns.
Verification, right.
Debt service coverage ratio, like a traditional commercial loan. It's really categorized as a commercial. You can put it in your LLC, you're ready to roll.
Right.
A few of them will allow land trusts. But so that's a whole new formation of paper. And you're seeing that those secondary market deliveries now are beginning to bundle $400 to $500 million blocks of that debt service coverage ratio, that DSCR paper. And you're seeing the major players who were, by the way, out of business for a while when COVID kicked in, but now they're up and running and they're issuing paper. And they're selling it service release. They're maintaining the servicing of it. Depends upon how their business model is. Yeah. But that's been a welcome formation. It's rational because if it's a rental, they should have rental income. But if they lose their tenant, they better have some reserves. So I coach them on, let's make sure that we have some money tranched for every property, right? So theoretically, you want every lease to be done separately. You want to have your deposits put in an account. You don't want to be spending that money. You want to have some reserves for the roof, for the septic, for the things when they pop up. So you have to have a liquid footprint for every square footage of real estate you own. and you need to be able to try to forecast what you think is a reasonable sum based off the age of the house, the age of the HVAC, the age of the roof. Does it have an irrigation system? Is it on public sewage? All that stuff, right?
So going back to what you said, with all this cash coming into Florida, now we've got homeowners who need to buy homes with a loan. They're competing against a lot of these cash offers. So do you see a decrease in the amount of mortgages that you are originating because of the competition?
Absolutely. Absolutely.
Yeah. And so what is that going to do to the interest rates if we're not able to lend out money on mortgages?
Well, so in a natural market, you would think that if there are no takers for the paper, that they would lower their rate to attract more clients. Right. But that's the form and function, once again, of that 10-year treasury, So if there are 10-year treasuries that are issued and there are no takers, they'll have to come in at lower bid ask, and that will concurrently then lower mortgage rates. So the credit markets are linked in that regard. So yeah, theoretically rates would come back down, but
theoretically, but are they going to?
I don't think so. I don't think so.
So what is that going to do to the market and to potential borrowers that no longer can purchase homes?
Yeah, they're going to need someone like Carrie Like, right? They're going to have somebody who's creative, find that property that's got some owner financing because the seller doesn't want to pay a capital gain. They want to, have, so you'll probably find more creative financing, and the unemployment rate's also quite low right now too. So the foreclosures might not be as replete. So there won't be as many distressed properties, but you'll see more renters like you do in some of these other areas I was describing. There are a lot of renters, obviously, New Jersey, New York, California, and Connecticut. Connecticut went through a weird phase like 3 or 4 years ago where you'd have a brand new house and nobody was buying them, right? So they rented them. And now they're selling them like hotcakes. So
was that because they were overbuilding?
Yeah. I think the tax model of that was interesting. I have a buddy who's an executive up in New York, and he chose to live in Connecticut. And then he said, "Hey, I rented this beautiful, 4-bedroom, 3,000 square foot house, townhome, because they couldn't sell it." And so, but now it's changing. The model's changing. Hard assets are a very attractive thing in inflationary times. Owning real estate means that the landlord will not be affected the same way. Entrepreneurs aren't affected by inflation the same way as non-entrepreneurs are. You can just increase the rent, increase what you're charging.
Right.
So, yeah.
So, what do you think? So I'm going back to, okay, so all this cash is coming in. We've got people in the, let's say, middle class income level that are now competing against these cash buyers. And now what I see is happening is it's further decreasing the inventory in the market, because if I'm someone who's in the middle income class category and I've got a house that I want to sell, but I know that if I sell it, where am I going to go? Because I'm competing with all these other cash buyers in the market. This is what I'm seeing, is that the inventory is continuing to stay low because of this problem that we're talking about.
That's right. It's an exacerbated issue, isn't it? And the only thing that will change that would be your demographic data, right? So how many people that are living in those homes are going to be cycling into a later stage of life where they no longer can maintain a home because of their aging out of that, right? Or they're on a fixed income, and then whenever there's a problem. So there'll be some demographics that'll play in. Builders are going to be building. You're going to see more suburbs, and then exurbs become suburbs. You'll see, so it used to be Davenport, now it's Ogdensburg or whatever it may be. So it used to be Kissimmee, then it was Davenport, then it was Ogdensburg.
Yeah.
You'll see that, right? So it's going to be fascinating. But I believe that the developers that own apartments and rental real estate are sitting on gold mines right now. Gold mines. I mean, those assets are rising, and people are going to be renting. And then you have a rental that you can request, and that's a median income number. What's the median income in the area? And those developers, when they do these apartment complexes, they use obviously a lot of the data, and they know where they can start, what delta point is. If you've got a bunch of single, dual income, no, or dinks, dual income, no kids, or singles, They know how many units to put in, what they should look like, and what they can get in rent, right?
Mhm.
It's sophisticated. It's a box. They plug it in, and they know that if they have a nice pool with a bar and a video room and all that, that they'll get some of these single guys or gals who want those nice little luxury pieces. So it's going to be a lot of renters too. That's just a guess, right? I mean, but it looks like that's where it's going.
Yeah.
So landlords are in a great position right now.
Hmm. Yeah, but it's also interesting too because with the building has slowed down. I mean, back in 2004 to 2006, we saw all this overbuilding, which also contributed to the crash as we had all of these new builds and building was just going crazy. They were putting houses up in like months, right? New subdivisions were going up like super, super quick. But because of all the supply chain issues, like I see them clear lots and then months and months and months later, they start building the house. And once they start building, I'm seeing it go up pretty quick. But I've talked to a couple builders who said that it's still taking 6 to 8 months to get trusses. It's still taking up to a year to get like windows and garage doors. And so that is further decreasing the inventory is because builders can't get these houses out fast enough.
That's right. And some small builders, meaning let's say you have a guy or gal that builds maybe, I don't know, 4 or 5 houses a year, right? Guess what? They built a couple of houses already this year or the last 2 years, and they didn't make money. It's crazy because they didn't forecast in a 20% increase in the truss or the delay. So profits are temporal, right? So if you have a pro forma and you're going to build a house and your normal vertical time and CO time is 6 months, and you just went from 6 months vertical to CO to 12 months, and you've got to pay your workers to go out there and keep things going, and then your supply costs have increased, and now temporarily you're extended out. You're not going to get paid until you're going to make your money at your CO, right? That's your closing is when you make your money back.
Yeah.
So the further that temporal period is extended, and then the higher the cost. So the national builders, they own a lot of the supply chain. So if you're a Lennar Homes or one of these Pulte's, you can operate on thin margins. You can operate on razor thin margins.
Yeah.
And you'll still do well. There are builders, luxury home builders in the Winter Park area where I live and operate. I live in Maitland, but right next door, that are building houses. And then you can call them and say, how much are you asking for it? And they'll say, I'll tell you when I CO it.
Yeah. Because it could change in the next few months.
That's right. I have a friend who put a deposit on a car, a Bronco. He ordered it. It came in, or it was on its way in. The dealership called him and said, "You gave us a deposit. I think he said 6,000. We'll give you that back plus 6,000 if you let us cancel your contract."
Wow.
A car. I know.
I don't like those new Broncos, anyways.
Yeah, I'm that. Yeah, I drive a 8-year-old Lexus, and my wife drives an 11-year-old Land Rover. So we're like, trying to be the millionaire next door type situation, but so these are interesting times, and so we have to bend and move, don't we? And so you're, to me, a consultant, right? I mean, I would pay you just to help me figure out what to do, because you've got all that knowledge and all that experience of how to do that. So we just have to just always be there to help people, and bend and move with the markets.
Yeah. So let's go back up to 30,000 feet. Where do you see the mortgage industry going based on what it is at, where it's at today?
Yeah. So there are people who made money in the mortgage business that, let's say they entered the mortgage business in 2018, when rates might have been 4.5 to 5. They got out there, they built relationships with realtors, they got some purchase business activity going. They'll be fine in that they'll hang in there, and they have a good network of realtors, and the realtors will eventually, just weed themselves out as to which ones will either stay full-time and successful, which ones won't. But the ones who just did refinances and were order takers, they'll probably have to figure out something else to do. And because they might not have that two business solution, they might just be focused on a commodity, right? And it's a tough situation. And so my guess is the number of originators will shrink, not as extremely as it was in 08. We had originators that had a Mercedes and were doing very well, and all of a sudden, boom, they were like turning the car back in and then buying a clunker and then giving their house up and going and renting and then trying to figure out what they were going to do. I mean, I saw originators say, look, I'm going to go back to school, get my degree, I don't know what they got it in, and I don't know if that helped, but they did that. I know some people that got into nursing and just decided to have a different utilitarian approach to what they were doing. But I think that the number of originators will shrink, and it might be 40%, it might be 50%, it might be 20%. I don't know, but I would say probably at least 25% will reapproach what they want to do and find something else to do. And then the ones that are good, that can hang in there, that have some savings, that have a network of buyers that can issue a pre-approval letter with a guarantee to close in 15 days with some escalations, and they're willing to do all that work, they'll be fine. Yeah, that's my.
And what is your thoughts on what are your how do you coach borrowers who are in that sweet spot, median home income, middle class income, who need to get a mortgage to buy a home? How are you coaching them right now?
Just with brutal honesty, it's a difficult time to be buying. I know you need to buy. You've sold your house after. I have a woman, she sold her house after a divorce, moved in with her mom, has a truckload of money in the bank, has a nice alimony check coming in, has a nice job, and she's got great credit. And I said, look, if the asking price is $275, in your mind, you need to be willing to go 20% higher than that if you really want this house. And we have to be willing to get this thing closed in 15 days without any conditions on the pre-approval letter. And if the conditions come back where you got to make a larger down payment, if the appraisal doesn't come in, or if we don't get a waiver for appraisal requirements, you have to be willing to write that check. So if they have liquidity, then we're fine. I had another gentleman that did a debt service coverage ratio. He had $800,000 in his bank account. I said, look, do a funds letter, give them proof of funds, and then after you get your contract, we'll do a mortgage. It's not like they were upset because he wanted to have an appraisal done. And he said, look, I'm having it done just because I'm choosing to get a mortgage. I have cash. I've shown you that I can pay cash. There's no mortgage contingency in this thing. I gave you a nice non-refundable deposit. And so if they have liquidity, do a cash offer, and then let's get a mortgage. If they don't, then let's be willing to go 20% higher. And then when we write the approval letter, let's put a guarantee close in 15 days without any conditions.
Yeah.
Right. And let's lock and load. Let's make sure that it's in the queue. It's got DU approval, pre-approval, and they can move very quickly.
Right.
And the appraisals are getting done a lot faster now because the appraisals.
Well, because there's not as many appraisals needing to be done.
That's right. And you know which appraisal management company that you should be using, and they know what they have to do to get business going. And they're going to be probably a few less AMCs moving forward too.
Yeah. It was crazy back in, was it 2020, 2021, when everyone was doing the refinances, because that's when the mortgage rates went down to like 2.7, 2.6. And we were struggling to get appraisals done for the houses that we were selling for the borrowers that were buying the house. It was like 3, 4, 5 weeks were going by waiting for the appraisal to get done. But I'm guessing that's starting to.
It is.
Shift now.
So what we would do is I would tell, we had a nice transaction, 7-figure transaction up in the Heathrow market. They wanted to have that appraisal done quickly. I said, then you're going to charge a rush fee. You're going to be charged a rush fee. It's going to be $300. So I just laser focused on making sure that we took it to bid. We communicated articulately how much the rush fee would be, and we just got it done, right? And it was in the contract. So that's how we approached purchases during that time. Yeah. And a lot of the refinances had waivers. They weren't even required to have appraisals, the loosening up, like I was describing earlier. And so now, yes, the AMCs are, I'm getting emails, phone calls. I mean, if I don't get 10 phone calls from various AMC or wholesalers a day, I would be shocked. It's got to be at least that. Because they're hungry.
Yeah.
They're hungry.
Yeah. And so today, right now, mortgages are at 4 to 5%. Were you working in the mortgage industry when the rates were like 12, 13, 14?
9. They were 9 when I got in. I got in 1987, and a 30-year fixed rate was about 9. A 6-month ARM was 7.
Okay.
It took a month and a half to get a credit report. It was hand delivered to the office. It took about a month and a half to get an appraisal.
Wow.
If it was an FHA loan, the conforming loan size when I got into business was $90,000.
Yeah. Wow. So you've seen
I'm old.
been through a lot of changes.
Yeah.
You're not old. You're just experienced.
There you go. I like that. That's a much better approach.
Full of wisdom.
Yeah, very wise.
Yeah.
So yeah, they were 9%. The debt ratios were very strict. 95% financing was like a 25, 36, 25 on the front to 24 in the front ratio, 36 in the back. Very few exceptions.
Yeah.
You couldn't, the stated income loans were reserved for a doctor or an attorney or a dentist or a professional, maybe 3 or 4 categories. It was an interesting time. There was no internet.
So it's an interesting time right now. And the reason why I ask about it is, do you see interest rates going up that high now?
So I don't know, is
Sure.
my honest answer. I believe.
I know you don't have a crystal ball there.
Yeah. I would say that because the U.S. Treasury and the Federal Reserve, even though they're supposed to be implicitly separate, right? The amount of debt we have right now as a nation relative to our GDP is becoming inverted for the second time in our history. The other time was before World War II. So as rates rise,
shortly after that.
I'm sorry, what?
And we all know what happened shortly after that.
Yeah, a war. Right. Not good. Yeah, we don't want that.
War and a depression.
In a depression. Now we would have experienced a depression in 2008 if we didn't have all the safety nets.
Yeah.
In my opinion, because
unemployment was a depression for a lot of people. It
was absolutely. I had an objective. I said, look, I had my kids in a certain school. I wanted to keep them there, right? I had certain standards that I wanted to try to keep up for my 3 children, and I did. Mm-hmm. But there were a lot of people that were. I mean, I saw people on EBT, which is the current way of saying food stamps, that were mortgage originators. The workouts, the modifications, was just an extremely difficult time. But with the fact that you can't get a mortgage now without verifying your income, it would be very difficult for me to fathom that that's going to be the future for the mortgage industry. I still don't see that, but I do see a slowdown, and I do see rates could easily go to, I don't know, 6.5%, 7%.
Mm-hmm.
Because this Fed chairman really wants to shrink the balance sheet, which is probably not a bad thing. Mm-hmm. Having a strong dollar, if we can, inflation is a tax on the poor. It's a miserable thing to be struggling and to go to the grocery store and have to downgrade from a dozen eggs to 6 eggs, or from being able to have a filet on Friday to having hamburger helper, which is a thing that you see when you're trying to stretch out a protein, right, with a carb.
Yep.
It's just, you can give your family more of that at lesser price. So that you'll see some of that. Yeah, you will.
Interesting. I don't know. We've covered a lot here. Is there anything else you want to talk about?
Well, so what I would say is that if you look at us as a country, our standard of living is higher than it's ever been. If you're poor in America, you're probably living better than many other people on the planet.
Yeah.
It's a good time for many people right now. This is a blip, but it's a real blip. And it's just part of reality. I mean, life is not a straight line.
Yeah.
And I use that line all the time. It's just not a straight line. And once we get that down, then we can figure out where we want our financial profiles to be and how we're going to live our lives. How are we going to organize our lives in a way financially that recognizes that life's not a straight line? And then where are there opportunities? Mm-hmm. And there are plenty of opportunities right now to help people get organized, get understand where they are contextually, manage where they are. There are plenty of opportunities. And so it's not the end of the world by any stretch of the imagination, but it's the new normal. And things happen faster now than they did in the past.
Yeah.
Things happen a lot faster. So yeah, it's just where we are right now. Mortgage origination it can't always go up and stay up. For anybody to believe that it's always going to go up would be a fallacy, wouldn't it? Mm-hmm. And borrowing is, you need to borrow money to do things. There'll still be people who right now will do a refinance to be able to accomplish objectives, and they can grab that equity. And those objectives could be consolidating existing obligations, and then creating a savings plan with that savings, right? It could be stripping or accessing equity to acquire other properties in other areas where there might be opportunities other than necessarily Florida or Central Florida. It could be the northern part of the Florida. It could be a different state. So there are plenty of opportunities for people, but it just requires, I think, a higher level of fiscal literacy, and we have to be focused on that.
Yeah.
You know,
Well, it also, you have to take a look at the big picture. I think in times of fear, people get so microscopic with their views because the fear does that to
it
you.
does.
You
Mhm.
focus in on the problems, and then you can't look at the big picture to fix the problems and to see the opportunities. There could be opportunities flying in front of your face. And if you're so microscopic thinking and so low resolution thinking because the fear is getting the best of you, you're not even going to see the opportunities coming. And like you said, people might still be refinancing even though the rates have gone up, because it makes sense when you take a look at the big picture. You take this piece and that piece and this piece, and you consolidate this, even though it's a higher debt over here. You can put yourself in a better financial picture, but you can't do that unless you step back
That's right.
and really start to delve into all of these different pieces that make up your financial life. And I
Well,
know
and that,
said something interesting when we talked a few weeks ago. You said you help people make decisions not based out of fear, because the worst decision you can ever make is fear based. It's
100%.
100% of the time probably not going to be the best decision if it's fear based, and a lot of people make decisions out of fear.
I agree 100%. You know, I read something called a Scary Times Success Manual, and I used it all through 08 and 09. And one of the things was that you want to stay connected to your network. You want to be on the phone, calling Carrie, chatting with Carrie. Carrie, how are you? What's going on? What do you see going on? Connecting with Howie, connecting with John. You want to be reaching out and connecting with your base, right? And you don't isolate. And then during those scary times, you also want to do a positive focus. And a positive focus is a very simple exercise I learned where you just take a look at what happened last week. So every Monday, what happened last week, Monday through Friday, that was positive, who was involved, and what strategic byproducts resulted from that positive experience. If you do a positive focus for 21 days straight during scary times, you will find things. You will unearth a diamond in the rough that you were unaware of. But you have to have an exercise in order to do it. And that positive focus exercise has been huge for me. And then another one, lastly, was the experience transformer, where if you've had a bad experience, you got to get that behind you as quickly as possible, right? We talked about Tony Robbins. He's really good. And I remember the techniques I learned in my 20s when I read Awaken the Giant Within, about, you know, having a rearview mirror and you're driving away from that problem, or
Yeah.
you're putting it on an air balloon and you're letting it go. It's a psychological trick, right? To allow yourself to not be wrapped up in a negative experience. But that experience transformer is another great tool that helps me reimagine what happened and then correct in the future what I learned from this experience. So now I have a system in place so that it doesn't happen again. And it's behind me, and I've got the positive byproducts from a negative experience, and I turn them into something positive. So during the scary times, you have to have those tools, and you got to rely on those tools.
Yeah. And I would say with those tools, it's constant practice.
It is.
It's constant.
Absolutely.
Yeah. It's and it's even more so when we are in the scary times, because that's when we start to forget about these mental practices that we need to it's got to be a habitual ritual every day that you're doing.
It does.
And like the Tony, I was listening to Michael Singer podcast. I just got turned on to him recently. And it's just listening to someone talk about that spiritual aspect of the world, about how we all try to manipulate our realities. And it's almost like we're trying to mess with what is. Sometimes it just is what it is in the moment. And we have to sit back and surrender to it. And until we do that, we can't figure out how to change the things that are going that we don't want to happen. Sometimes we just have to allow things to unravel and for them to happen, for us to sit back and say, okay, this is how I'm going to take action, or this is the opportunity that I'm going to seize today. But he says people get so wrapped up in wanting to change the circumstances right here, right now. I've got to do it right now. And it's like you're almost saying, I've got to change nature. I've got to change the forces of the universe right here, right now, when they've been going on for billions of years. How can you do that? You can't do it unless you surrender to it. You sit back, you look at the big picture, and then you start to take action on it, not based out of fear, but based out of a confidence.
Love it. Love it. The first step in solving a problem is admitting there's one, right? And that acceptance and that letting, allowing the gravity is here. So we can't deny that. So it's happening. Let's admit it. Let's realize that we can't control that there are things. So what is it? The serenity prayer says things you can't control versus things you can.
Sure.
You can, that I guess it was a German priest that said that. It's a great prayer and people love it. You have to be able to discern reality, and you have to be a realist.
Mm-hmm.
I just ordered a book, Ray Dalio. He's a bit of a interesting guy. He's a very, very successful money manager, and it's called, I think, The Coming New World Order. And he essentially talks about the rise and fall of empires and how to make money and how to be aware of all these things. But he's a very rational person, and it's interesting stuff.
I've read a Ray Dalio book before. I can't remember which one it was, but he's very smart.
He's a bright guy.
Yeah, that sounds like an interesting book. So he talks about empires in history.
Yes, he goes back to the Dutch and the United Kingdom, and essentially what he's discussing is that if you look at the trade imbalances and the things that are happening, America is moving, unfortunately, in a certain direction that's not like maintaining the empire status. And what does that mean? And it's essentially just a way. I don't necessarily agree with 100% of it, but it's still worthwhile to read and be open to it.
Mm-hmm. And what's it called again?
The Coming New World Order.
The Coming New World Order. Interesting.
Yeah, it's the rise and decline of empires.
Interesting. Okay.
Yeah, that's the current read.
To add it to my list.
And I always like asking people, what are you reading? Because then if they're a reader, and then you can kind of get an idea where they are. Yeah. So yeah.
I'm reading Robert Greene, Power 48 Laws of Power.
Okay. All right. I'll make note of that. Robert Greene.
It's interesting because I'm reading it and there's a lot of controversy. It's a national bestseller, but there's a lot of controversy over the book, and there always has been, because the 48 Laws of Power, a lot of them are actually very manipulative, deceitful. But what he does is he goes back into history and writes about examples of the observance of this law and the transgressions of this law. And he goes way back into time with different dynasties and empires, and has some modern day examples too. But I just listened to him be interviewed on Jordan Peterson. Jordan Peterson interviewed him the other day, and I happened to be reading his book, and I was like, oh, Robert Greene. And he actually talked about this 48 Laws of Power. And why did he write it? Because it is controversial. And even Jordan Peterson was saying, I don't really quite get it, because it's very deceitful, some of these laws. And so it was a really interesting interview to see. Basically, it gave a little bit more context on the background of where the writing came from. And so when you read it, you do have to take it not literally. You wouldn't want to use, I don't think, some of these things that he talks about in a literal way, because they can be very manipulative. But behind it, the message behind it is actually it's very interesting. And what he said was that the book was actually well received by the music industry. He ended up writing a book with 50 Cent, I think, after this. Wow. And he's this, like, he said, it's kind of weird because I'm like this, white Jewish guy, and I teamed up with 50 Cent, who, we're like,
that's hilarious.
The backgrounds couldn't be totally opposite.
Right.
But this book was well received by the music industry, because the music industry can be a battlefield of manipulation and dishonesty, and it can be really hard to maneuver through that, especially someone coming from the streets who is offered an enormous amount of money with this contract that has all of these very manipulative loopholes for the music industry. And so apparently this book became really popular with musicians, and 50 Cent was one of them. And so again, I guess they ended up writing a book together.
Did you read Jordan Peterson's 12 Rules for Life?
No, it's been on my list of books to read. He said that it took him 15 years to write that book, and it's a bit of a book.
Mm-hmm.
Have you read it?
I read it. And then I'm also reading Maps of Meaning, which is his original book.
That's his newer book, right?
No. The original book was Maps of Meaning.
Oh, okay.
Then he did a simpler, more kind of Main Street 12 Rules for Life.
Interesting.
And then his next one, I think, is
it
says Order, something with order. And I haven't read the next book.
I was talking about it the other day. Yeah. He's a fascinating individual. Sometimes, though, he'll get on the podcast with someone who is of his same level intellect. Like, I'll have to break down a sentence word for word to understand what they're talking about, because it's like every other word, I have no idea what that means.
I wrote down all the new words I learned. Like, I'll read his book, Maps of Meaning, and I'll learn like 4 new words every day. And I'm like, this guy's vocabulary is just so expansive, you know?
It is. And I wish I had that same vocabulary, because he can express himself so clearly. And for some of us, that can be really difficult. We know what we want to say, but we can't get it out because we don't have that vault of words, of vocabulary that he can just grab from the vault at any time and find these words that so clearly define and demonstrate what it is that he's trying to say, even though some of us can't understand it, but you can and you can't. I mean, a lot of times I can understand the gist of what he's saying.
His self-authoring program to me seems fascinating.
His what?
Self-authoring.
Oh,
he has a program.
Where
he teaches you how to write a book of significance. It's called self-authoring, and you can enroll in the class. He's an amazing guy. You know, he's controversial because he's challenged some of the stuff that's going on, but he's an amazing guy.
I think anytime you're a deep thinker and you question things, you're always going to be controversial, because he is not someone that's ever going to think mainstream. He is always going to question. And what I like about him is he questions all sides. Even though I know which side he's on, he still questions it. I mean, he's talked a lot about religion, and that I've heard him define himself as a Christian, yet he questions so many things about Christianity. So he admits he doesn't really know.
He does.
And it's so funny listening to him on the podcast, because he'll have this stream of conscious where he's just talking, and you can tell he's just really thinking about something. And then all of a sudden he'll stop and he'll say, so is there a question in there? Like, he's trying to think, is there a question? Right. And you're like, I don't know. Is there a question?
He's very bright, and he interviews some great people too. He's the most watched person on YouTube, I think, in the history of YouTube.
Is he really? Wow. Yeah. I got turned on to him last year, and I've been listening a lot to him, because honestly, it's been a substitution for the news for me to understand what's going on in the world. Because he talks about everything from spiritual to religious to politics, and in a way that, again, it's not, this is the truth, this is the fact. It's, this is what seems to be going on, and let's question it. Why is it going on? What does this mean? How do we define this? And so I think for me, it's been a better source of news than mainstream media news.
I agree 100%. You and I are on the same page.
Yeah.
Totally.
So, all right.
How
can everyone reach you if they have questions, they want to reach out and connect with you?
Sure. They can go to the website valueshield.net, or they can call my office at 407-628-8130. be happy to talk to them.
Yeah, definitely. You guys reach out to John. Gosh, we've known you now for, I don't know how many years, and you've been to some of our events and on our
Yep.
shows, and we've reconnected through the years. And so I greatly appreciate the friendship that we've developed over the years, and the help that you've given us with the financial planning. So I'm
Thank you.
grateful to have had you on the show today.
Thank you, Carrie. Have a great weekend.
You too. All right, guys, take care. We'll see you on the next episode. And remember, you're only one deal away.